Hey there, I'm Jake Hurwitz, founder of The Gallery, and welcome to our first episode of the new podcast. I co-founded the Global Startup Studio Network back in 2018 and was one of the authors on The Rise of Startup Studios, which is the first white paper about the asset class. And ever since then, I've been working with hundreds of studios all over the world on everything you can imagine, from fund structure to branding to legal documents to you name it. And over the years, there's been an enormous amount of chatter and a lot of growth in the startup studio asset class, but there hasn't been one centralized place for the conversation about studios to take place. And so I'm launching the gallery to put it all in one place. Our first episode is one that I'm really excited about. It's with Byron Dailey, who's a partner at Fenwick. If you're not familiar with Fenwick, they're a massive law firm. Byron is one of the most brilliant and successful lawyers in the studio space and many other spaces. But he's worked with countless studios, some of which you may recognize by the names of Science, Platform, People Brand Company, and quite a few others on their legal structure. He spent more years than anyone I've personally met and seen researching the model, figuring out the right legal structures that new studios and established studios should use and follow. And otherwise, it becomes typically the most costly and stressful and time-consuming processes that any new studio encounters. So in our first episode, super excited to sit down today with Byron to dig into the various studio structures and legal structures that he recommends, that he's built over the years. And hopefully this is valuable to you. Be sure to subscribe to our newsletter, where you'll get not just every episode every week, but also an article, a newsletter sent directly to your inbox, plus daily social media content on every platform. So without further ado, let's dive right in. Welcome to the gallery. Byron, welcome. Tell us about how you first found yourself working with studios. Just real quick background before we dive in and share your screen. Let's give everyone an idea of how you got here. What's going on?
Yeah, sure. So as you mentioned, I've been leading the fund formation practice here at Fenwick for several years now. And, in that practice, I have a lot of startup partners who are the best startup partner, among the best startup partners in the world. And a lot of them have contacts with, people who have exited very successful startups, and then, one common path is that someone will do that and think, look, I can build a lot of startups and I should raise money to do that. And so several years ago, we were starting to see a real uptick in, those kinds of referrals from my partners come in. And I was starting to, so I started to work on more of these, and I was starting to really think about them a lot more carefully and with, longer term, more in-depth strategic mindset, because I was seeing like some of them came to us sort of clearly with the mindset of, well, let's do this like a startup. Some of them came to us, well, let's do this like a fund. And, neither of those I thought were perfect, especially the former. And we were seeing, really just, I was seeing that there was no, unlike funds and unlike startups, there was no established customary way to organize a venture studio, or even really in a, sort of its cousins, accelerators or incubators. And so I just, as I was working on them, I started to think in much more depth, and talking with my startup partners, my tax partners, and trying to come up with a much more well thought out framework for how to approach this. And so over the years, I've developed that and implemented it, like you said, with several clients, and the industry for startup studios or venture studios is really booming now, and so we're continuing to see more and more, and continuing to kind of hone that and
Totally.
come up
And
with
for everyone
different
listening right
models.
now, I'm sure the reason you're probably here is because you realize that the fund structure, the legal structure, is the most complicated, the strangest, the weirdest thing that you're dealing with. Extremely expensive to figure out, can often take a year or two for studios to figure out what's the right structure for them. There's a lot of different approaches they can take. There's very few resources on it. Most of the lawyers I've talked to are still figuring it out as they're going. And I mean, Byron, I'm so glad we met quite recently, actually, because you're really the first person I've met who has first lawyer I've met who has actually dug in and looked at this from all perspective. I mean, we're talking global tax, we're talking entities in different countries, we're talking accounting reasons, and then of course legal reasons. You've looked at this from every angle. So let's just dive right in. Let's share your screen and break down the handful of models that you recommend, and specifically with each of them, really curious how you went about developing each of the structures, and like what are the considerations behind each. So essentially, for someone who's considering launching a new studio or already in the process of launching a new studio, what questions should they be asking themselves to help figure out like which of these structures is best for them?
Yeah, I think that there's a lot of issues that you can try to optimize for, and so there's things like tax, right? You don't want to pay more tax than you need to. There's things like intellectual property, because when you're creating companies, just like when you're creating startup companies, it's really important that the right intellectual property is owned by the right entity. That can be very, very crucial to the startups you create and their ability to get venture financing, their ability to have exits, whether it's being bought or going public. There's other stuff like there's other sort of securities and very legal things, but I think even at a higher level, and I'm going to flip to the first picture in just a minute, but at a higher level, I think there are a couple of basic questions that I think are kind of easy to understand but hard to figure out how to implement, and that's where we really started. One of which is, what are we going to? What's a good structure to make it effective and easy to layer in more capital when I'm out of money that I've raised and I'm ready to raise more capital, right? So, and then second, or maybe even first, actually, is what is it that the investors are really investing in? Because when you're raising money into a startup, it's very clear what people are investing in, right? They're investing in the company. They're investing in the thing, in the operations, in the company that the founders are building. When you're raising a fund, it's clear what they're investing in. They're investing in the portfolio of companies that you're going to invest in. And I think a lot of people come to studios and they think it's like a startup where you're investing in the team, because if it's a good, compelling team, right, they want to invest in what's compelling. But I think that's the wrong answer in most cases. I think in most cases it's more like a fund where you're not investing in the team. You're investing in what the team creates, which is a portfolio of companies. And I'm going to pop to this diagram here. It probably looks pretty complicated at first, but I'll try to demystify it a bit and explain sort of why this is a kind of what I call a standard framework that we usually start the discussions with. So there's one, kind of ignoring the startups, there's one operating company in this structure, and I just call this, generically Studio Opco, right? That's where the R&D happens, where the IP creation happens. That's where the employees are. I don't, I think that a lot of the time people think that's the thing that's going to be raising the money. Because they are thinking of it like a startup. But I think that the real answer to what are your investors investing in? It's not that. They're investing in these startups down here that you're going to create, or that you're going to incubate, you're going to co-found, whatever your model is, because there's a lot of different models for this. And so one of the things that this model does, and it's very much got infrastructure that looks like a fund, but as you said earlier, we avoid talking about funds. We avoid, in most cases, we avoid the word fund. We avoid the word carried interest.
Why is that? Yeah,
We
why
avoid
why
the word
avoid it?
GP. Yeah, the reason, the reason is that if you're really doing this as a, pretty much a pure studio and not kind of a hybrid fund studio, which sometimes we see. If you're really doing this as a studio, the the economics that you as the manager of this studio should be getting and your team should be getting are very different than what VC economics are, I think. Um, because you're doing something very different. It's a very different business idea. You're not just looking for companies to deploy some capital into and then more or less be passive in them. You may, at most have a board seat or something like that and sort of provide advice along the way. You're doing a lot more than that. You're on the purist model here. You're literally the founder of these companies. You're creating these companies, and founder economics are much different than VC fund manager economics with respect to the companies. And what we find is that as soon as you start talking about this like it's a fund, your investors are going to expect that they're going to have 80% of the upside because of the traditional classic 80-20 carry split for a VC fund or a
Yeah.
PE fund or whatever. So one strategy that a lot of our clients try to use is using nomenclature that is
Yeah.
not venture capital fund nomenclature. So that's why in this diagram, even though if you sort of blur your eyes a little bit, it looks kind of like a fund structure. We avoid all that nomenclature so that we can, what I coach folks on when they're raising money into these is to start right off the bat with making it very clear that you're doing, what it is they're investing in. They're not investing in something that sounds like or feels like or smells like a fund. They're investing in founders of multiple companies. They are the first investors into a bunch of companies that you're going to start. And so the economics should be different. The economics look very different from one to another depending on the strategy, the model, whether there's co-founding going on, whether there's kind of other things going on. But it in many cases it should not be that the investors
Sure.
get 80% of the upside. A lot of the time we see more like 50% of the upside or 60-40 either way, kind of depending on the model. But so that's why we, one of the things we coach folks on is
Sure.
avoiding all
I have
fund
I have a quick question on
nomenclature.
that. And in
And
my experience, both advising
yeah,
studios and raising money for my own studios, I mean, so often, even getting the first meeting with an LP, potential LP, becomes difficult or not even doable because they start sniffing elements of a fund that has really wonky fees and carry numbers, and they're like, well, I'm not, why would I ever invest in a fund that gives 50% carry or takes 20% in fees versus 2 and 20? So when a new
yeah,
studio is just
yeah.
doing their soft circling, just trying to get the initial meeting, and maybe they have a send off deck or it's just over a quick email or a voice memo, how do you recommend they describe what they're doing to get the LP excited but not already going down the path of like, well, this is not 2 and 20, I don't understand it?
Yeah, yeah. It's a great question. It's a very important question, and we think a lot about how to help our clients, really maximize their chances of fundraising. Because, even though venture studios are becoming much more common, there's still no, like I said, still no standard model. Most investors are very unfamiliar with the concept, and so I think the best strategy is, um, to come out of the gate with a kind of a very short term sheet. It's very different. In a fund, people know what to expect. So we usually, and the market usually sees like people coming out with like a 15-page term sheet or something like that. But I say, come out with a term sheet. So first of all, don't like slap this slide in front of your investors. Back years ago when I first kind of developed this, we had some clients that tried that. Some succeeded and some sort of struggled. And I think the reason they struggled was like you said, it sort of, people might think, wow, this is either, this looks like a fund, or this has got kind of really unusual economics. I think you want to start simple, just like any pitch, right? Start simple, start with what is really going to be important and compelling to the investors. So I don't know if you can see me sort of moving my cursor around on the screen, but I think the only thing you really want to show to investors, whether in a picture or in words, is sort of basically the entity that they're going to invest in, and really, maybe not even that. You might just want to talk about these startups. I think that's what they should really be interested in. Talk about, because you're selling the idea of, I'm so good at building startups that I'm going to create a portfolio of them, and you're going to have the first stake.
We've got an LLC above that holds all the startups we're going to create, and you're going to invest directly in the LLC. Is that correct in this model?
At most, yeah. At most, you would say that. At most, you would say, yeah, we're gonna hold those in an LLC. If that's the model that you end up following, because it's not always. There's a lot of different variations on this. But yeah, you'd say, hey, look, you're gonna invest in an entity that's, what I'm gonna do is I'm gonna fill it up with these startup stakes, and then on this version, and then you investor and we studio are gonna share in the winnings of that portfolio. That's basically, kind of the whole pitch. It's like, I'm really good at creating companies. I'm going to create a bunch, and you're going to have the, you and the other investors are going to have the, first stake in these, and it's going to be a significant stake. And, to convey that in a 2-page term sheet, maybe a 1-page term sheet. Don't talk to them about all this other stuff until and some of this stuff you don't have to talk to it until later, but basically that's it. Say, look, I'm going to create a bunch of companies, and you're going to
Okay.
have a stake in them. But as you get into the details more, you can then, once you've kind of got them hooked on, okay, this is the pitch, this is the investment opportunity, and it's exciting to them, then you can start explaining a little bit more, because they're going to have to see what that, they're going to ultimately going to have to see what that LLC operating agreement says. And then, then things get complicated, but I think, a painful way to fail at this is to make it complicated first before you've pitched them on the really the simple idea.
So for this first model, and what's the title for this first model, like the OpCo model or something?
Yeah, I just call it
Okay.
the standard framework for a startup.
Okay.
A startup studio.
In what circumstances would this be the right fit? This model?
Yeah, I think this one's got essentially, and I'll scroll through some of these other examples, and these other examples don't even illustrate all of the examples that we use, but they are illustrative of some different ways we can go. But this one is kind of has all the bells and whistles on sort of, a version of this. So some of these others that I've got that I'll show are simpler versions of this, because a lot of the time somebody will look at this and they'll go, wow, this looks complicated. There's a lot of entities. And then so I say, okay, well, I'll talk through and explain why I've got all these entities. And no matter how compelling my explanation is, some people say, look, I just want to start simpler. And so, we've got ways to do that. But this is the one that sort of optimizes for a bunch of different things. It allows you to have a team of employees at your studio, not all of whom have to be accredited investors, who can receive an an equity stake in the success of the portfolio that perfectly aligns them with the incentives of the investors. An investor, if you can convey that to the investors, that you, studio founder, and your whole team are economically in lockstep with what the investors want out of this, they should love that. All right, and so this and anytime you grant team members equity in something, you're going to have to figure out the securities issues and the tax issues, and this optimizes for both. It gives you a lot of flexibility and allows you to and your employees should love it too. So this is the one where it enables you to have it, not just you and your co-founder, but you can hire 5 people, some of whom can be folks that otherwise wouldn't be able to, they're maybe they're younger or whatever, young hot shot folks that you want on your team. They may not qualify as accredited investors, but you can still grant them under this structure. I don't need to go into the weeds of how. Anybody who wants to talk about that, I'm happy to. But this optimizes for that. It makes it so that when you grant those equity stakes to them in the success of the portfolio, it doesn't trigger any tax liability for them. So it's got, it's the best possible tax and flexibility situation for your investors. This model also is this exact version of this is kind of what I call also the pure startup studio model. And what I mean by that is that this is the model where your studio is going to create from whole cloth a portfolio of companies. So that's what I call the pure model. There's other versions that some people might call incubators or accelerators, but where there's you might, and you can hybridize with those, but where you might have pre-existing companies that they want to plug into your studio and what it has to offer, whether it's developing IP or whether it's management advice and consulting along the way. There's different versions of this that can accommodate that. There's different variations on this, other hybrids where you might say, yeah, I want to create some companies, but I also want to be a VC with some of this money, because maybe there's just going to be some companies I want to invest in, and maybe some of those I will also provide consulting services for, or help develop, development services, whatever. And so, but this is kind of the pure model, and the one that allows for you to accommodate the most flexibility for who your team is, and giving them profits.
So to kind of start to kind of close the book on the standard framework before we move on to others, would you say, to conclude this one, I actually have a follow-up question now that I think about it, but on the standard framework, would you say that if you're looking to start a mostly traditional startup studio where, we've got a core team, we've got capital raised, we're going to start 4, maybe 8 companies a year from scratch, and we want some level of founder equity in each of those companies and investor level equity, so common and preferred stock, this is the best model to start with?
I think this is I don't know if I would call it the best model to start with, because I've seen so many different ways. What I would call it is a very useful way to start trying to figure out what model you should use. And so that's how this works as a tool for me and my clients. I say, look, let's look at this. Let's talk about what all these pieces do, and then let's talk about how your strategy and what your investors might be interested in might be different.
This might be a bit of a detour, but a really important question nonetheless. Do you see a world where there's one standard model for every new studio that pops up, just as there's one standard model for every VC fund for the most part?
It's a great question, and it's one I've definitely thought about it. I I don't think so, because there are other good models that we've developed with some of our clients that are sort of they are a departure in some ways from this. I think there's gonna continue to be a lot of variations, but there's principles that really hold up, I think. And I think so. If I can, I'm going to switch to the next slide, because this next slide sort of highlights one issue, which I think is one of the primary issues. And I think this concept should be mostly universal in however you structure it. And historically, based on what I've seen, other sort of studios that have been formed, and they come to us and say, all right, we need some help. This isn't working. This is one of the things they haven't solved for. What this is showing is, well, what happens? All right, I've raised the money in from that first group of investors in this first picture. I've created this portfolio of 3 startup companies, and those are going great, but now I want to build some more startup companies. What do I do? And so what this shows is, you don't probably want to try to raise money into that same structure that you already raised money into. You don't want to layer it on top. You don't want to follow the model of the way that startups raise money, because it just creates way too many complications in this, for this business model. You can do it, but it's almost for sure not worth it. And so I think this is like, in my initial version of these diagrams, I called this kind of this startup pool model, to kind of highlight that you're creating multiple pools over time, basically pools of capital and portfolios of startups. I've sort of shifted to just referring to these as portfolio 1, portfolio 2, so successor portfolios. So I think that the 2 concepts that are really shown here, which is, number 1, your investors probably want to invest in the startup companies that you form in a portfolio structure, and not in the operating company, because the operating company is not where you're building value. And number 2, when you are ready to raise more capital, you probably just want to replicate it and build a separate, a successor portfolio to create a new, distinct portfolio of startup companies. It's going to use the same studio opco as shown in this diagram, but it's a separate portfolio. I think that those concepts, as sort of basic, fundamental, kind of strategic and structural concepts, hopefully the industry will move towards those being universally applicable. But I think there's still going to be variations on how this happens, just simply because we have variations on this that we've built and are building right now, that kind of look different than this. And at a later date, I'm going to build out a slide that kind of shows those as another example. But they are different, but in the print, they still have these same principles that I just highlighted, which I think should be ideally universal.
All right. So just to kind of like sum up this one a bit, if the way I hear this is,
Yep.
if I want to start a studio, but we've already moved some money, we've already raised some money, there's already something happening, or we intend to raise more again, this is a good model for us to start with. Could this also be a good model to start with if you're like, I just want to go prove my concept. I want to prove a concept fund for, 6 to 18 months and show that I can raise $5 million. I can build 4 companies with that, with my co-GPs, and then use those results and that initial IRR to raise our second round of funding to really go all in. Would this be a good model?
Yeah, I think so. But I think what we often see is that when people do that, they want to start with a slightly simpler version of this, and that often makes sense. And those are what some of my later slides show. But so there are ways, and I think that happens really frequently, where it's like some version of proof of concept where, in some cases it's a self-funded, right? And so, look, we're not going to raise money, but we need to show that we
Yeah.
can build a couple of companies, because it's a big ask to say, investors, commit your capital. I promise I'm going to
Right.
build some cool companies,
Right.
but I don't know what they are yet. So just trust me, give me full reign over your dollars, to do that.
Yeah.
That's a lot of trust. And so it helps a lot if you can build a bit of a track record, prove your
Sure.
concept first. And so a lot of the time, you don't need all the bells and whistles of this structure. You can start out with some version of a simpler one, and you can morph in as you need these other features. You can sort of evolve into building on these other features. So it's just a good time to flip onto those other slides that kind of illustrate that there
Yeah.
are simpler versions of this. They just sort of they
Sure.
come with limitations. So first, well, maybe we should first mention this slide, because
Okay.
this is kind of simple. This slide, what it shows is that this answers a bit of a different question, is, well, what happens when these startup companies that I've created start to get some traction and they independently are growing and need to raise more capital? There's a couple of really good answers to that. One of which is they can just raise money from third-party VCs like any startup. Maybe a more interesting answer to that is, well, you startup studio can raise your own fund, manage it out of the same opco that you use to run the studio. You can raise a little fund, a little opportunity fund or a big opportunity fund, that its whole purpose in life is to deploy capital into your most exciting startups that you have created. That way, we have to, there's legal issues you have to manage there, but they're definitely manageable, around conflicts of interest and stuff.
I remember there was a big conversation taking place around like 2019, 2020 of, raise $25 million in your first round of funding and save half of that for reserves, which is to follow on your most successful venture so that you can keep
Right.
riding your equity stakes through the waterfall. Like that was kind of, those are the phrases used. Is that how you refer to this? Is that
Yeah.
still the concept here?
Yeah, that's sort of a different version of sort of this, a slightly different version of the same sort of general strategy, which is like what you're saying is, like, we can raise enough money into portfolio one that we can just tell the investors when we're raising it, look, half of this money is going to be used to create a portfolio of 5 companies, and half of it is going to be used sort of as it's going to be used opportunistically to pump some more money into the best of those portfolio companies, as needed, so that we can, avoid dilution from other investors as long as possible. This is a variation on that, that's a perfectly good idea. But a variation on that is, well, okay, what happens when you run out of that money, or what happens if you didn't build that into your initial strategy? Is there some way that we can be the VC that provides the Series A or Series B or whatever? And the answer is yes. You can just raise a fund. Just because your studio opco is a studio opco doesn't mean it can't also function as a VC fund manager, and it can be the management company for a fund. And this is just, illustrating that that's an option, and that means that you can be the VC and participate in the you can get the management fee and carried interest there. You can be free to use venture capital fund terms because you are just raising a venture capital fund. So let me jump into the sort of, this is another, I'll wait to talk about that. So here's sort of like the simplest version of this you could do, short of just starting some startup. The simplest version of this is really just to start some startups, right? As a founder, just be a serial founder and say, look, I'm going to start 2 or 3 startups. I'm going to be the founder. I'm going to raise a little bit of money into each of those. And that's my proof of concept that I am good at building new companies. those are often the folks that have the easiest time raising money into a studio. Their first studio is people who have had at least one successful startup exit that they've built. They're not the only kinds of people that can do this, but those are the people that often have the easiest time because they've shown that they can build cool startups. And so there's investors who are like, yeah, I want to be the money in the next 5 startups you build. And so
Yep.
let's lock in that agreement. So that's really the simplest version. But this is sort of slightly in between version where it's like, all right, let's start. And we have actually, started out some really sophisticated um, studios based on this model. We started a pretty well, and I'm not, because I'm going to mention a little bit of specifics. I'm not going to mention their name, but it's a pretty well known sort of blockchain developer focused studio. It's had some real success, a lot of capital invested into it, and we basically started them off on this model of um, just let's just for the first iteration of this, let's just let the investors come into the studio. Let's forget that whole thing of you're not investing in the studio. Let's maybe manage that in the drafting of the studio LLC operating agreement. But let's just create one entity, bring a bit of capital in. Let's bring $1 million or whatever in, and say we're going to create 3 companies. Let's just have one entity. Let's simplify everything um, and do that. You can then, and put the companies under the studio, right? It looks fundamentally different from what I showed in that first diagram, but you can evolve very easily from this as iteration 1 to that as iteration 2 or 3 once you sort of have proven your
Sure.
concept here. And so this makes it hard, as I note in the notes on the slide. One of the things it creates challenges for you to the counterbalance the simplicity of it. One of the challenges you can't really, there's tax issues around how you compensate people with equity and how that works in LLCs, and so it makes it so you can't really properly do that equity stake that I talked about earlier for your, if you hire some people, you can evolve into a version that does that, but there's alternatives that aren't quite as good that you can build into this. It also, it entangles a group of investors in your operating company, which can get a little clunky once you evolve into that later version.
So
Um,
it kind of sounds like, and I'll try to summarize what I'm picking up on, and correct me if I'm wrong here, but
yeah,
it seems like what you're really recommending to new studios is start real simple, prove your concept, generate interest, generate demand. Don't shoot yourself in the foot by misguiding or misleading potential LPs around what you're actually doing here. And as you grow and as you
yep,
have success and as you have failures, you're going down the studio journey, the life cycle, and new considerations are going to come up. Like your team needs to grow, or you need to raise more money, or you need to inject more money in specific companies. Maybe you need to double down on focus time and energy and efforts into specific portfolio companies. So what you've done is it seems like you've then built models that can lead into the next model and evolve as that journey unfolds.
yeah, yeah. One of the things we try to do is to help our clients not make any irreversible decisions or box themselves into a corner, right? We want this to have flexibility. Just when I'm focusing on this picture, and I'll show you sort of some slight variations on that. But one thing to mention, this is like the most basic tax, like no for a studio, but you'd be amazed at how many we see that come to us and they're sort of designed improperly, right? The basic thing is when people think of this as, um, with the startup mindset, they think corporation, right? This is an LLC. They try in these kind of diagrams. There's a bit of a hidden tax code, and tax code is not the right word because tax code means something else, but there's a hidden language, there's a hidden visual language that tax lawyers and tax advisors recognize, which is that triangles mean things that are taxed as partnerships, they're flow throughs. Squares mean things that are taxed as corporations. We have frequently seen basically this model, but with the studio being a corporation. We've seen it with some pretty prominent ones. And that's just in almost all cases, it's a terrible idea because you're gonna put yourself into a situation where when you've got an exit of one of these startups, you're gonna be paying a lot more money to the IRS than you would have had to otherwise. And that's just a terrible outcome. And hopefully, folks that are doing this have enough foresight to recognize that that it's worth spending a little more money on sophisticated advisors, legal or tax or whatever, because you're going to save a lot more money by doing that, right? If you organize this as a corporation and one of your companies succeeds, and why would you be doing this unless you absolutely believe that at least one of your companies is going to succeed, right? So it's just a basic assumption that you've got. If one of them succeeds and you have to pay another layer of corporate tax on the exit there, you're going to pay the IRS a lot more than you would have had to pay your lawyers to set it up right. This is a good way to start if you either have no investors, right? You're just going to self-fund it, or you have maybe a very small number of investors and not a lot of money from those investors. So it is kind of a proof of concept with a couple of very close friendly investors. And you only have a small team, like 1 or 2 or 3 people.
Which, I mean, what you just described is 90% of new studios that are popping.
Yeah, exactly. So it works really well for that. As soon as you want, so we've got some clients that start a little bigger though. Like, this is very much in between the two models, right? There's that very simple model I just showed here. And then this one is like, well, what if I am raising enough money that I'm going to hire like 2 people even. And those 2 people are, 25-year-old, graduates of, Stanford or MIT or something that are going to bring some very high powered, obviously you don't have to be from one of those schools, but somebody with some very high powered, ability to, it's younger, and they're not going to be accredited investors most likely. And what I want to give them that incentive stake in the success of this thing. We've definitely got clients who come to this and they're like, all right, we're going to raise $5 million maybe, or $3 million. And it's going to give us enough money to pay a couple of people, but those people, we want to incentivize them, but they're not going to, and so this allows you to do that. It does, I misspoke a little bit. This one actually, got to be careful about the whole accredited investor thing. But there's ways of actually moving these pieces around to accommodate that. So this is kind of an in-between. And then, so there's that was kind of the in-between one if people wanted a little bit simpler. But some people come right out of the gate and they're like, all right, I'm going to raise 20 million bucks. And I'm going to hire 5 people, and some of them are not going to be accredited investors. Really, they should start off with that, with the kind of full-blown model. It's enough money, and they it fits, and it's not. But like I said, people have different desires for simplicity. There's a lot of different ways to do this.
Okay. So kind of recap here. We've gone through 5 models. Are there more models that you'd like to break down, or is it just these 5 for now?
I have no more. I don't have any other pictures, but let me describe sort of another way of. So one of I'll describe sort of an aspect of this model that is not present in all of the models we got, and then I'll cover a slight variation on this one. I'll just spend a minute on each of those. So, an aspect of this model is that, like a fund, it runs all the economics through this sort of portfolio holding company here, the startup portfolio one, and then it splits the upside between the investors and the studio team. Um, there are other versions of this where maybe the investors, for some reason, you might not want the investors to sort of be in an entity with you. Maybe the investors just want to hold some shares directly. Um, Maybe you want to say, look, each startup new code that I create, it's going to issue some um, stock to the startup portfolio one that only the investors have an economic stake in. And then there's going to be sort of studio holdco one that maybe, in some cases you would put founder shares in there, common shares in that, and that's the one where the economics would run up here. So there's slight variations there. You don't have to do it this way. We have some pretty successful versions on that model. And then this diagram here shows, this is one version. This is kind of like an accelerator or something where, I call a virtual portfolio company model, where sort of setting aside, the question of whether you're creating these companies or not, that's irrelevant. You can go either way here. But what this illustrates is a model where, regardless of whether you created the companies that are in your portfolio or you just, invested some cash into them, this is a model where they're going to outsource some or all of their operations and or development activity to your studio. So that's why I call it a virtual portfolio company model. You can basically form a startup corporation and it's got its IP in it, but it might not have any employees. It might not have any employees managing it. It might not have any employees developing IP, software, whatever for it. You might have a model, it can create real efficiencies, but to just sort of use your studio as the centralized outsourced operations or development hub for some companies that are sort of still trying to see what traction they have. We don't want to go through the complications of having employees down at each of those or even management down at each of those. You don't need that stuff. You just, need somebody to sort of sit in the place of a board member and an executive, but that can be, you don't have to have employees to do that. But this is just to illustrate that there's variations like that can be really effective and efficient. And yeah, and it's kind of just a, like I said, I call this a framework because I think literally all of our studios that we've set up are different from each other in some way, but they all sort of take sort of concepts and learnings from these different kinds of models and structures that we've developed to try to optimize for various things. And so they decide, what do we need to optimize for? What do we want to optimize for? And what do we want to simplify?
So I have a couple of kind of high level questions I'd love to get your opinion and perspective on as we start to wrap up. Just for a new studio GP out there who's, let's say they've decided they want to start a studio, but they haven't built any companies yet. They haven't raised any money yet. They haven't finalized their deck yet. Maybe they have a few friends or recent past investors who are like potentially interested in getting on board, but they're about to commit to the long haul of this. How much time and money should they expect to spend in the foreseeable future in getting their legal structures finalized?
It really depends sort of which direction you're going. If you're sort of like the simplest version that I described it, like if you're what you described, it sounds like it's someone who's not already had kind of a blockbuster exit, right? It's somebody who just, they're full of ideas, they've got skills, they're full of skills, full of ideas, right? But they haven't
Let's
proved.
say both. I mean, I've seen many of those examples. I've also seen many examples of the GP who has had a great exit, and now maybe they just bought a new house, they took a year off, and now they're ready to start building a whole portfolio of startups.
Yeah, so I think the answer is very different for those two people because also they're probably their financial wherewithal is a little different too. And but most importantly, the story that they have to tell to potential investors is very different, right? And so I think for the person who is sort of really starting from scratch, they've got amazing skills, they've got amazing ideas. um, I think they need to start as simple as possible. They need to prove their concept. They need to basically, I think, probably just start a couple of companies, just straight up as a startup founder. Um, Probably not even at most sort of start them under, a holding LLC if but it's not really necessary. Um, just because that's the got the lowest bar to entry as far as um, there's a simple model for that. You can even hire a premier startup firm like us, and we will make that accessible to you because it's the way to set up a startup company. It's very very standardized. um, just take the simplest approach, do that, start up one or two companies, and build them for see what you can do for a year or 2 years, and then evolve into then I'm in a position where if I've you don't even need an exit necessarily. You just need um, some to have done something like that in a way that looks exciting to investors. You can even do that and then say, look, I did this. I bootstrapped my way into these two companies where I bootstrapped in, plus I raised a little money. But I'm going to now raise a studio. I'm going to take the leap to do something a little more sophisticated. And um, one thing you can tell investors is, look, these are this one or two cool companies that I made. Not only are they cool companies, but I'm going to actually roll a stake in those companies into this portfolio that you're going to invest in. So right off the bat, I'm going to give you some. It's not going to be a purely blind, not fool, pool that I'm creating. Uh, it's not a completely blind pool that I'm creating. I'm going to give you, visibility into these guys, and that's sort of a version of what VC funds do. That's called warehousing. Um, Sort of a different version of that. And then, but if you've got the other, so that person, it's going to cost what it's going to cost. The first steps are going to cost what it's going to cost to create a startup, which is it's the initial pieces of it are, possibly in the single digit thousands, but definitely under 20,000 to do it in a really sophisticated, robust way. And you can, um, and that's really fast. You can do that in a matter of days if you need to. But you can start, don't be afraid by the 20,000 number. It's going to be less than that. I'm just sort of being very general. But if you are the person who's had a, you've had a blockbuster, you've already done that. You did it just because that's what you were going to do. You started a company. It was an awesome company. You sold it for hundreds of millions of dollars, or you were a part of the team, whatever. If you're that person or some version of that, um, the story, like I said, you've got a very different story that you can tell your investors. That's going to be probably more, give them a lot more comfort in handing over their money to you to create a portfolio of companies. Um, though we formed one, just had its first closing a few months ago with exactly that story. The guy that built $1 billion company, and then he immediately got a pretty well-known VC to fund his studio from as the anchor first investor. For that person, I'd say it pays then to sort of build something a little more robust, a little more, got some more features. It's the all in. It's hard to know how long it's going to take, because it depends how long you're going to take talking with those investors about in what detail, but minimum handful of weeks to kind of put the whole thing together. Let's say you put together the whole first structure that I talked about, all the bells and whistles in that one. Minimum, you're talking about, let's say that there's someone's going to raise 20 million bucks, and they're a strong first studio founder. I'd say give yourself at least several weeks just to get all the stuff put together. It's going to take longer to raise money. It's going to take that long to open bank accounts too. And that's, you should be ready to spend, realistically, probably in the neighborhood of $100,000 out of the studio's capital, but out of it can be less than that if you don't have negotiations with investors. It can be 60, 70, 75, something like that. But it can be more than that if your investors are the kind of investors that are going to negotiate a whole bunch and kind of fight to get this looking the way they want to look. It can be more, but there's always a decision when that happens of, well, how much money is this person bringing to the table? They're going to invest $5 million. Yeah, it's worth spending an extra $50K in legal fees to negotiate that, so we get a fair deal with them and a robust, well thought out deal with them.
I ask it because it's mind boggling to me how many new studio GPs we talk to, and first of all, many of which don't even realize they're going to need to spend time and money to figure out the right model for them. And then they get pretty deep into these conversations with investors who now already have preconceived notions of what the model is going to look like. And then they have to crawl themselves out of that hole to build a model that sort of looks like a Frankenstein model. And that's a problem. And that runs them well into 150, 200K. And so as we start to wrap up again, just real quick, in one sentence, what would you say is one piece of advice you would give to aspiring studio GP when it comes to starting to think about these non-sexy, often scary and daunting structures that are fundamentally and foundationally extremely important for them?
All the answers that are flowing through my head are very self-serving, but I think that's whether it's talking to me or someone else like me, I think it's really important to talk to someone who has thought through all the issues and all the things that could happen down the road, and helps you come up with a structure that that optimizes for those things. Yep. And your success, right? Because that's the ultimate thing. And to be clear, to design that doesn't cost all those dollars we just came up with. It's to actually build it that does. And so, it's much less to spend, a few hours with someone like me and sort of come up with your design. And then, and that's actually, I wanted to make sure to mention that, is like those big dollar amounts, 100,000, more than 200,000 for, very complicated, highly negotiated ones, bigger ones. We stage the process, right? So that what we do first is we figure out what structure you need, right? Spend 2, 3, 4 hours on Zoom with you, coming up with the structure you need, and summarize that into that like 1-page term sheet we talked about, or 2-page or 3-page term sheet, maybe a little picture, that help you put together your pitch deck. And then we pause. That's a small minority of the work that on the legal side that needs to be done here. Even that would even include talking about all the how you're going about creating IP and finding IP, and there's a lot of nuances there, right? So you stage it. So it's worth the investment because it's not like you're going to be spending, $75 or $100,000 just to have that conversation. You're spending a small minority of those dollars to have that conversation and come up. We try to think really carefully and almost naively at the beginning. Like we try to think like, all right, we've never done this before. What do we have to worry about? Because we've never done
Yeah.
your project before, and your project's different than everybody else's project. So we try to really think ahead and about all the things that you want to optimize.
It makes sense. So you're saying, start with 3-4 hours, quick term sheet, like primer it, and then go soft circle that, go out into the market, get interest. Once you've gotten real momentum with potential investors, with negotiations already on table potentially, and then go spend the money and build the model when you need it.
Yeah, yeah.
Byron, this was awesome. Hope everybody listening who stuck around for the full breakdown here got a lot out of it and is motivated now to maybe rethink their model, maybe chat with Byron. I'll repeat again, like I said early on, if you do want to connect with him and the Fenwick team, fill out the contact form below so that they're not inundated with random cold messages. And I will personally facilitate a warm introduction, and you guys can have a quick, initial call to see if it is the right fit. And I will say also for studios out there who may already have a lot of loyalty to a specific lawyer and counsel, maybe have been with them since their previous ventures and all. And if that lawyer is already well underway in creating the model for their new studio, or they're getting started, or it's been done already, it can't hurt to have second eyes on this. I mean, I want to see Byron work on more structures, so I certainly have an interest in it. But I do recommend, and he gets it as well. There isn't just one firm here for everybody. There are lots of firms, but it's good to have this checked by the folks who have really been around in this since the start. So, Byron, thank you so much.
My pleasure. Thank you.
Really excited to see all the new studios that pop up. Really, just because of this episode, I think it's going to be a great one.